Welcome back. We want to go through in part two of how to buy a business. We want to talk about the process. My name is Stephen Beal, and I'm the principal and owner at Beal Business Brokers and Advisors. We help people buy, sell, and value their business. So I want to start with an overview of the process, and it's best to think of it in sort of 4 steps. The first step is to start off with you. What are you looking for? How much money do you have? How much money do you want to invest? What's your business background and experience? What location are you looking at? Are you looking at your current city? Are you looking across the country? What are the regulatory issues in the type of business that you're looking to buy? And what are all the other factors? So the first column you can think of as focusing on trying to determine the type of business that makes sense for you to buy. The second step is, once you have a better handle or a good handle on what you're looking for, the next step is to start your search for a business. And there's many different ways of finding a business. What we'll talk about is the classic approach using a business broker, someone like our firm, and the approach that most professional business brokers use. So essentially, a business broker will prepare a 1 or 2 page business summary. It's referred to as a teaser because it won't reveal the name or the address of the firm, but it'll give you enough information to make you decide if you want to get more information. In order to get more information, at that point, you'll be required to sign a confidentiality agreement or a non-disclosure agreement and give some of your own personal information to the broker just to make sure that the business is a good fit for you. So once you've signed the confidentiality agreement and disclose some of your information, you should get a more complete data package. At that point, you'll find out the name of the business, the address, you'll get some level of financial disclosure on the business, and it'll have things like number of employees and just a general description on what the business does. At that stage, you can make a decision, is this of interest or not? The next step after that, if you have some basic questions, you might just ask them directly. But the next step after that would be to meet with the seller, maybe take a tour of the facility and see the place and make a decision. Okay, is this the right one? Does it make sense? And so you decide, okay, I'm ready to make an offer. And so you make an offer, and we'll talk a bit about what format that offer will take. We use the term loosely, to make an offer, but there are many different legal formats for making an offer, and we'll talk about ones that are better to use than others. Once an offer has been made, you get into negotiations with the seller. Obviously, there'll be some negotiations typically about price, but also maybe about some of the terms, like say training or closing dates or a whole host of issues that typically arise in any business transaction. And so hopefully at the end of the negotiation stage, you reach an agreement with the seller. So you now have a tentative agreement. All business transactions will be subject to certain conditions. Certainly finance might be one of them, but the one that will always be there is what's referred to as due diligence. And this can be thought of as the home inspection phase of the process of buying a business. So due diligence can mean everything from checking to make sure all the equipment is in good working order to making sure there's no lawsuits outstanding or that there's no hidden liabilities. There's all sorts of things that go into the due diligence phase. And it can essentially mean anything that the buyer and or the buyer's lawyer choose it to mean. So as we move into the 4th column, the due diligence and the financing stage of closing the deal, those conditions need to be satisfied in order to get to the final closing date. So at some point you'll say, okay, my due diligence checklist is satisfied, my lawyer is satisfied, my bank is satisfied, my accountant is satisfied, everyone's satisfied, you're satisfied, and you say, okay, I'll sign off on all the conditions. And at that point, you're ready to move forward and close on the transaction within the next few weeks. So let's go through in greater detail so each one of these steps and the overall process. So I mentioned a confidentiality agreement. I've often got asked by potential buyers, why do I need to sign a confidentiality agreement? All I want to know is where the business is located. And to be honest, the identity of the business and of course their location is typically what is what is confidential. Obviously, the owners are concerned about their financials being disclosed, but they're really concerned about the fact that they are up for sale getting out there. They don't want their employees to find out that they're trying to sell the business, because timing is uncertain. They could, between the day they start the process and the day they actually close the transaction, it could be 6 or 12 months. And they don't want their employees, with all that uncertainty, to start quitting. So they don't want to lose their employees. They don't want to scare their customers if their customers find out they're for sale. Or for that matter, competition. If they find out a business is for sale, they could try and use it against them. So it's in your best interest as a buyer to try and keep this information as confidential as possible. So in terms of businesses that are out there and what types of things to look for, you know, they always say that when you try and find a job, there's 80% of jobs are found on the hidden market through families and friends and connections. And unfortunately, it's similar with businesses as well. Certainly a lot of businesses change hands from family members. So in their next slide, we'll get into exact percentages, but easily the largest single chunk is families passing businesses on to their kids, or management. If a business owner owns a business and he has a good solid management team, he may ask them to buy into the business. So if you're an outsider, if you're not working with a firm that is looking to sell, you can talk to your friends and acquaintances, or lawyers or accountants, or business brokers like myself. And we also do what we refer to as a professional proactive search. So if you know the type of business you're looking for, and we can narrow it down and create a list of 50 or 100 businesses, we can actually knock on doors and place phone calls to actually find the right business for you. So as I mentioned, the business market out there, family transition is the largest single chunk. Probably around 35% are transferred from parents to kids. The next biggest chunk is a non-family management buyout. So the owner, his family isn't interested, so he looks at his management team and maybe he picks 1 or 2 managers and they're interested in buying. So that accounts for another 20 to 25%. The third chunk of pie in there is about another 25% where it's an external sale. So the owner doesn't have family members, he doesn't have a management team that can afford to buy him out. So he looks externally, and that's the largest role we play as a business broker. We get involved in those external sales. There are a chunk, of course, that just wind down. The business closes because it was unprofitable or there was no buyer found. What studies have shown is that approximately 2/3 of business owners out there don't know the true value of their business. And I would assert to you, after having done this for almost 20 years, the 1/3 who think they know the value of their business are wrong. So basically, businesses are very difficult to value, and we've touched on that in our valuation seminars. It's not like residential real estate where you can find out what your neighbor's house sold for, and you can say, okay, mine is plus or minus a couple of percentage points or a couple of $1,000s within that price. First of all, what businesses sell for is not public information. Second of all, how do you do that comparison? How do you know how comparable your business is to the guy on the other side of town who just sold his business? Another interesting stat is that 93% of business owners don't have a formal exit plan. So this suggests that only 7% have ever thought through, how am I going to exit my business, and taken the time to actually write it down and say, this is my process to exit the business. So that suggests if you're thinking of buying a business and you have some in mind, this is where I mentioned a search program. This is where what we look at, that basically 93% of the businesses we talk to, they never really thought of how they're going to sell their business. So if we approach them, they may be interested in talking to us. Some of the worst businesses to buy, I shy away from talking about industries, because in every industry there's good and bad players. So if you pick the worst industry out there and you look at Stats Canada, there'll be people who are making money in that industry, and there'll be people who are losing money in that industry, and they have that information all in Stats Canada by industry types, and you can see the dispersion of profitability in pick any industry. So it's really not industry that drives it, it's really sort of characteristics of things that you want to avoid. For example, if the company hasn't been profitable for 3 or 4 or 5 years. In part 1 of this seminar series, we talked about reasons to buy an existing business, and the key one, the very first one, was you make money from day one. So why buy an unprofitable business? Unless you know what you're doing and you know how to turn it around, you want to run away from businesses that aren't profitable. Again, if businesses are under too much competition, you want to take a look at that, and again, make sure you understand why are there too many competitors. If there's customer concentration, if you have one customer that is more than 25% of the sales volume, you might want to take a closer look at it. The seller won't back up oral representations. Typically, people will say, oh, all my equipment is in working order. That should make its way into the final documentation. The seller isn't going to give you a 1 or 2 or 3 year warranty on the equipment, but at least on the day that you buy the business, the equipment that he has that is necessary for running that business should be operational. If he has key employee risk, this is another red flag to worry about. Or if the seller can't produce records that you can look at and you can have your accountant look at to understand the business. So these are things red flags to look for. On the flip side, some of the best businesses to buy out there are, again, we're not talking industries per se, but these are just characteristics. So the owner is compelled to sell. This is basically negotiation 101. If the owner doesn't have a solid reason to sell, it may be tough to negotiate a reasonable price. The seller may say, well, I'll wait until someone offers me 2 times what it's worth, and then he'll sell. So you want to look for an owner who has a solid reason, like he's looking to retire, he's looking to move on, a good solid reason to sell. You also want to look for a business that can pay more than your current salary. I mean, maybe if you find the right business and you just love it, you can take a pay cut, but you might get tired of that after a year or two. You want a business with some stability there, some tenure, so 5 years or so in terms of growth. Again, going back to the reasons why buy a business rather than start one. You're looking for something that's got a track record that is provable, that you can take to your bank and actually finance. And steady growth, of course, helps as well. That's not to say that if a business is sort of flatlining, that it's not necessarily a bad business. If you've got a good vision for it, that's certainly something to look at. So I mentioned making an offer, and typically what we do as we get to that stage, we like starting with a non-binding letter of intent. When you actually make a formal written legal offer, you're actually bound. If the seller accepts your terms, you're locked in. So what we typically start with is a non-binding letter of intent, which is a very simple, short, 3 or 4 page document that outlines the major terms and conditions of the proposed sale. So this helps us move a negotiation along without either side spending thousands of dollars with lawyers drafting up 50 or 100-page documents. Like I said, it's a short document. It gets it cuts to the heart of the matter. Certainly, there'll be other things to be negotiated afterwards, but they will hopefully be less contentious than things like the offering price, the timelines, how long you want the seller to stay to train you, all the conditions that might apply to the transaction. So all of those things should be negotiated in a very short, non-binding letter of intent in order to get them out of the way before lawyers start drafting up these 50 or 100-page documents. On that point, you also want to make sure that you have an approval clause by your lawyer so that your lawyer can review all the documentation. Inventory and working capital issues are always complicated, and so it needs to be absolutely clear what's going to happen, what is the expected level, and what's going to happen with adjustments. You also want to make sure you have enough time to complete due diligence. It's going to depend on the size and the complexity of the business, but you need to make sure you have more than, say, 1 or 2 weeks to do your due diligence. And as I mentioned earlier, if the seller says something about, yes, all the equipment is in working order, that should make it into the final contract or offer that the seller backs up those those statements. The other step, we talked about due diligence, and so what you're looking for in due diligence is substantiation. So again, if the original package says revenue was $10 million and the bottom line was $1 million, there should be detailed financial statements and tax returns that support that number. So you want to substantiate all of the information that you received earlier. You want accountability. So who is stating this, who's signing off on it? And you want complete disclosure. So the seller should be able to disclose to you things like if there's ever been soil contamination on the land, or if there's been any lawsuits in the business. All of these things should be disclosed so that you're aware of it, and you and your legal team can handle those issues. So just to recap again on the process, to go back to our four columns. Step 1 is what is your criteria that you're looking for. So basically, know what you're looking for. The second one is screening out the businesses that just don't qualify. So the more you know what you're looking for, the easier it is to focus on the ones that qualify. Step 3, you meet with the owner. You take a look at the business, you make an offer or a letter of intent, and you start negotiating on that letter of intent so that you can get quickly into the due diligence phase and review what you need to. And the final phase, you've got an agreement in principle, you move into due diligence, you get through that process hopefully quickly, and get an agreement with the seller that works for both parties. So just to touch a bit on what we do, certainly as for buyers, we can help you as a consultant. If you need assistance on valuation, we can assist you there. On due diligence, we can help walk you through that. Structuring the deal and financing the deal, we can assist on there. And as I mentioned, we also do a professional proactive search system where you say, I don't have a business yet, but I want to find a business in a certain area. We can reach out to people in that field anywhere in Canada and see if they'd be interested in selling. Also, we work obviously as a business broker where we work for the vendor. So some of these things, for example, valuation, we can't do on a business that we represent the seller because that would be a conflict of interest. But how we do help you as a buyer is we help you find a good business from our list, one that fits what you're looking for, and from our network. So thank you for taking the time to sit through this part 2. We're moving on to part 3, which gets into valuation of businesses. So we'll touch briefly on the valuation process and things that you should look for in as you're going through the buying process. If you have any comments or questions, feel free to email me or visit our website and put a question through our website, or visit our blog that's on our website as well.